Hi, I'm David Armstrong. I'm managing editor of wealthmanagement.com and Registered Rep Magazine. We're at the Tehran CEO Conference in San Francisco. I'm here talking to Jeffrey Gundlach, the founder and CEO of DoubleLine Capital. Jeff, thanks for taking the time.
Thank you.
So clearly, financial advisors, wealth managers, and you're speaking to a bunch of them here at this conference, have a difficult task with their clients. Their clients are looking for principal protection as well as a little bit of growth in their portfolio. Difficult to find these days. Where would you suggest that they look? Where's the place to go for protection, but yet a little bit of growth?
Well, I think you have to make a decision whether you want protection or you want growth. The way I look at things is you should be favoring protection in the next year or two, and don't worry about growth, because I think the opportunity that you'll get in the next 1 to 3 years, 3 years probably at the outside, is going to be so large that it won't matter if you didn't make much money, say, in the next 12 months. The way you phrase the question is interesting, because that's exactly how people think. They want investment strategy that goes up some sort of threshold amount, kind of in perpetuity with no volatility.
At least to beat inflation, maybe, or at least to keep up with inflation.
Sure,
maybe.
So today people want, say, 5% or something. And they probably want 10, but they're hoping for 5. And that's just not the way investing works. Sometimes it does when you're in a period of a long cycle, like we were from, say, 1982 to 2007, or at least 2000. And then you get into a transition period where lots of rules of the game have to change. And if you keep trying to do what you did before, you're really going to miss the bigger picture. So what I'm doing is, for sort of macro investing and multi-asset investing, is holding a lot of cash. Moving to very low risk, low interest rate risk, and targeting what will happen under my thesis out 2 or 3 years, and get ready to buy non-U.S. equity markets. Basically, is what I'm looking towards in the years ahead.
I was going to ask about this. You know, the dictum is that the time to invest is when there's blood on the streets. I mean, do we see this in Europe now, or is there opportunity in Europe for?
There is, if for short-term high-risk trading during those moments where things are looking rather dire, like they did in, say, June or early July of this year, and then if you got the stomach for it, you can make quick money that way, like you could in Spain. For example, I was positive on the Spanish stock market starting in late May, and it's gone up a lot. I wouldn't own it now. Basically, in Europe, what you're playing for is you're playing that these politicians and central planners will be able to get confidence back, and they're able to do it over the short term through rhetoric and a circular financing scheme. My position, though, is that it won't work, and that ultimately there will be some substantial geopolitical changes. And that's really what I'm looking for when I say great opportunity coming.
Do you see a breakup of the European Union?
I see a breakup of the euro almost certainly. At this point, they almost seem like they're paving the way for Greece to leave or get kicked out. I think it's possible that you have enough social unrest in Spain that becomes an issue. I just don't think that the euro is ultimately going to work. The big question that needs to be asked and answered, and they haven't really even quite asked it yet, is the German society willing to basically disgorge all of the gains that it got as the beneficiary of the euro? In other words, are they willing to finance the debts of the periphery or to transfer wealth to the periphery? I just think that that's so out of context with how societies work, and certainly the history of European society, that's not going to happen. And therefore, it seems like the euro is not going to end up with the United States of Europe, which is what you would have to have, you know, not just this kind of rules system for budget deficits, but an actual government that's unified. I find that very hard to believe that that's going to happen. So, I mean, interestingly, there's just the opposite is now happening in the United Kingdom. There's going to be a vote on Scotland breaking out of the United Kingdom. It looks like they're going to vote to stay in, but it seems like things breaking apart is kind of the order of the day. And
so you think there's opportunity there when that happens?
Well, I think there's radical change represents opportunity. The challenge is you have to be in a position to move then. So you can't be in, you know, you weren't in a position to buy the S&P 500 in March of '09 if you bought it in '00. You were probably licking your wounds too badly to want to take another stab at it. So it used to be, you know, the old adage used to be stay fully invested and for the long haul and all that. That works during a long-term super cycle, but that's not where we are. We're in a transition period where lots and lots of things are going to change. I think the United States tax code has to be radically overhauled. I'm hopeful that that will happen in my lifetime because it's so desperately in need of happening.
Certainly needs a simplification.
Well, I think so, and also, you know, a simplification would go along with more sensible rules. You know, I think the income tax was amendment was 1913 or 1914. I can't remember which, but it was about 100 years ago. And I think the first tax form was 2 or 3 pages. Yeah. Pretty easy to do. Yeah. And now you have all kinds of crazy results. The one that's in real time is, you know, Governor Romney and his absurdly low tax rate relative to anybody else. And you'd think that would be an opportunity for him to say, let's address this issue.